As Ed says, the market was harsh on the Nick Scali shares today. Yet, as I say, the half-year profit, have a look at this. It was up by 70% to $60 million. Nothing wrong with that. The interim dividend, it was up by 5 cents. 40 cents a share there. It seems to have been, as Ed says, the lack of a definite outlook for the current 6-month period that spooked the market. So today I caught up with Nick Scali Chief Executive, Anthony Scali in person, just asked for his explanation about that stock market reaction.
Well, I think there was a bit of nervousness on the recent trading outlook, which was January, which is a big month for us and a good month. And we were down on last year's January, but still way up on the pre-COVID January. So we've had a boom, particularly a COVID boom, if you like, furniture particularly, because people were at home. And I think they're overreacting to the fact that we were down on last year, which is a boom year, and not giving us any credit for the fact that it's higher than pre-COVID.
Is it frustrating for you as a chief executive when you see things like that happen?
Well, it is, but it's, look, I've been around quite a while, running this business and been through the cycles, and really, I'm not going to run my business on short-term views of fund managers or shareholders. We have a long-term strategy. We know what we need to do. We keep the store growth going, so... No, I don't. I just have to ignore it.
Is your business more aligned to the housing market? Is this more a concern or a commentary about where maybe markets think the housing market is going in Australia?
Yes, we are. We are aligned to the housing market. When people are moving homes or moving to apartments, downsizes, we benefit from that. People buy furniture. However, contrary to that, there's a lot of refurbishments happening. People are refurbishing their homes. You can't get a tradie, as we know, and that's beneficial for us, which converts to what we call replacement lounges. So that's still, I think, fairly strong. And
so inflation during these COVID years has obviously risen, adding to your costs. Are you seeing any relief in those, in particular in the shipping, because that was a big one?
Yeah, we're seeing dramatic relief. So in the peak of the COVID, we were paying $8,000 for a 40-foot container. Right now, we're paying $800. That has a huge impact on the cost of goods because furniture occupies a lot of space in a container. So we're actually now reducing some of our prices because of the shipping costs falling so far.
So I was going to ask you about that, because consumers, there's a price point at which they become resistant to paying more for a lounge suite. The ability to bring down that price, does that mean you're hoping to generate more sales through that?
Yeah, we're hoping to generate more volume along with dollar sales as well. Yes, exactly right, because we buy product at specific price points, and during COVID we had to go beyond that. Let's call it target price point that we think the consumer is the right price, and we've been able to get back to that. So hopefully, it's going to be better for the consumer. They're going to pay less for furniture.
So Plush you took over as well. Is that bedded in as smoothly and easily as what you imagined?
Yeah, it's fully integrated now, the Nick Scali. All the Plush product runs through our distribution centres. We've integrated the IT distribution. We've got a lot of new product going in the Plush.
And that gives you a new price point for consumers in a different market?
Slightly different price point, but not too dissimilar to Nick Scali. We're refurbishing every Plush store. It'll have a new look, a better look. It'll present better.
So given the fact that the market also thought maybe you gave guidance, but you were uncertain as to where you might land in 6 months' time. I mean, is that just the reality of any business right now, trying to figure out what happens to interest rates, what happens to inflation?
Oh, for sure. I think it's very difficult to predict what's happening. I mean, in my view, January was better than we expected, but clearly the market didn't think that. They were expecting more, but yeah.
That's right. But then you've also got to work out your own stocking as well, because your warehouses obviously are key to this. You've got to figure out how much stock you're going to have in those warehouses, because that clearly affects your results.
Yes.
So that comes to trying to work out how much demand. This is the difficulty of running any business, any consumer-led business right now.
Yeah, particularly now. Yes, you're right. It's planning, merchandise planning is a real challenge at the moment. But anyway, look, if it's good product and you're overstocked, it doesn't matter because you just sell through it. And all our product we've always managed that pretty well, so I'm not concerned about that.
Okay, and then tell me about the consumer themselves. When you're looking at the consumers and their behaviour, is there any trends you're seeing right now that are surprising you?
No, look, it's been similar the whole way through. We don't see, they're not reducing price, looking for lower price points. They're still buying the same high and low price points that's selling at the same volumes. So we're not seeing any move towards lower price points yet.
And so this business that you're in, this has been a fantastic business over a very long period of time. I mean, trying to work out your debts, trying to work out how much debt or how little debt you should have on board right now, these are all things to make certain this is a sustainable business over into the very long term as well.
No, exactly right. So, yeah, look, the dividend was 40 cents, was an increase of 5 cents. I think some people expected a bit more, but we want to pay down that corporate debt. We've got a little bit, not that we have a lot of debt. We prefer to have property debt and buy retail sites. That's been our strategy, and we want to continue that. So I think still at a 67% payout ratio is still pretty good.
Yeah, that's right. 70% jump in profit, 13% fall in share price. I can't work it out either, I'm going to tell you. Anthony Scali, always good to chat to you.
Thanks, Ross. Thanks.